All right, folks. Here it is at last. Thank you for being patient with me. This is part one of Portfolio Review. In this video, we'll go over the strategy, the conditions that we have to understand before we begin buying and selling stocks for this year, 2024. Then we'll go over the long portfolio, the recent moves that I made, and the charts. We're going to leave it at that. Then in part two, we'll do the short portfolio. Part three, we will do the fundamentals, looking at the earnings and the trends name by name. And of course, in between, we'll do stocks battles. For example, the battle of the refiners. That will be video number 1, Valero versus MPC. And then we'll do, for example, battle of healthcare, which pharmaceutical company should stay in the portfolio, which company should leave, if there are any other choices that we should be adding, etc., etc. But we begin here with this video, and the title is, It's All About the Margins. What are we talking about here? If you say, hey, Maverick, give me one advice in stock market investing, just one thing that I need to know, I would say the margins, the margins, the margins. Show me one stock that improved margins year on year and the stock underperformed. It doesn't happen. This is why we call it the bottom line, the net income, and most importantly, the growth in net income year on year. And you see that the stocks that lead the stock market gains are usually these stocks that lead the expansion in margins. Of course, in different monetary phases of the stock market, such as in quantitative easing, the growth in revenue becomes more important. But as we head to tightening and normalization, the growth in margins become more important. So if you look at the year 2020, for example, which stocks led the stock market gains? Stay-at-home stocks. And if you listen to the media and the narrative, they would say, okay, it's because everybody's staying at home. And these are companies like Zoom, for example, and Peloton are the ones you want to be in. But from a fundamental standpoint, is it just investing based on what do you think? Oh, I'm staying at home. I'm using Zoom more, so I'm just going to buy Zoom. No, it's all about the numbers at the end of the day. And these companies showed massive increases in growth in revenues and margins. And that's what really mattered. In 2021, everything went higher, with exception, of course, of the stocks that begin to slow down in margins. Those are the stay-at-home stocks from the year before, as folks began taking the vaccines and moving out and about. So the margins for those companies began to go down. But everything else, as we began to see the stimulus impact and inflation, under these circumstances, companies can charge more. So we see the pricing power, expansion revenues, top line and profits, most importantly, the margins, bottom line. So in that kind of environment, it's really easy to outperform. And this is why we've seen most companies doing pretty good in the stock market. And the reason is the consumer is not really that price sensitive. They have stimmies. Sure, we have inflation, but they can afford it. They can pay because now they have an extra source of income. In the year 22, we have seen the beginning of Fed tightening. Dynamics changed. Folks began to become more concerned. Spending behaviors changed. We have seen that companies with great margins in that year outperforming the rest. And by the rest, I mean the majority of the stock market, specifically the big caps, the technology stocks, because they've hired in 2020 and 21 with the assumption that those dynamics of huge demand and stimulus will be with us for a long time. They were proven wrong because consumer demand went down while their cost was still way too high. So their margins went down big in 22. And this is why we've seen the big caps going down, and with them, of course, because they were waiting, the major indices went down. But energy stocks, with the rise in commodities prices, managed to outperform because the margins expanded. Healthcare did the same. Go look at the profits in the year 22. For these big pharmaceutical companies, they retained the pricing power and their cost did not increase by much. Companies with the pricing power, such as food companies, managed to outperform in 22. Insurance companies, they can jack up the rates and there's nothing you can do about it, so they can maintain the pricing power. Defense contractors, same thing. You'll see that their profits expanded in the year 22. In the year 23, which companies led the stock market? Certainly not the companies from 22 because commodities prices went down. So we haven't seen energy leading. Energy was the laggard, as an example. Companies that used to enjoy the pricing power now faced a weakening consumer. All of a sudden their margins go down. So they underperformed. But the big cap technology stocks had the luxury of being able to reduce cost without sacrificing the growth in revenues by getting rid of thousands and thousands of employees. they did that, their margins improved, and we made a video about it from 22 to 23. We haven't seen revenues being expanded by these companies, at least most of them, but we have seen the growth of net income being restored. And that's what mattered. Those are the stocks that managed to move higher, and because of their big weighting, they pulled the indices back to the highs. Similarly, semiconductors. Those are companies that enjoyed the AI mania. All of a sudden, we have a surge in revenue, surge of demand, pricing power. They become the pricing power leaders. So now their margins expand and their stocks lead the stock market. So again, we look back and we say, oh, the stock market doesn't care about the fundamentals, Maverick. Yes, it does. If you dig down, it does. And it's all about the margins. So in the year 24, what companies will end up outperforming? The answer is, you guessed it, companies that will make the best margins. Well, how do we know which companies will make the best margins for the year? Well, we have to do the macro analysis of demand and inflation conditions, Fed policy. But before we do that, let's talk about different margin scenarios. And as you can see here, we have 5 scenarios, all of them with different possible outcomes for net income. In scenario number 1, you can see revenue in green and cost in red. And of course, in scenario number 1, this is a rare situation. You don't see this a lot, where we see revenue expanding in positive territory, but we see costs going down negative. We have seen some of that in 23 in the name NVIDIA, for example. The AI mania gave NVIDIA massive pricing power because of the lack of supply for these chips. So all of a sudden, their revenue shot up significantly higher, while costs went down. And in this dynamic, we see insane outperformance by these kind of stocks. But again, this is the exception, not the rule. In the second scenario, which is more common than scenario number 1. This illustrates good management. In a regular year, positive year, bullish year, good consumer demand, any company under good management will have higher growth in revenues than the growth in their cost. And of course, the difference is the margin, aka the net income. And so long as it's positive and moving higher year on year, then you'll see whatever stock that is moving higher and outperforming. Now, in certain years, we could see the growth in revenue year on year negative, but it's not going down as much as the growth in costs year on year. And all in all, the difference produces positive net income, and the margins remain positive, even though revenue growth is negative year on year. But cost growth is more negative year on year. We have seen a lot of that in the year 2023. We talked about Apple, for example. Revenue growth was negative year on year, but costs went down by more year on year. All in all, the margins for the company improved year on year, and the stock managed to recover. So now that we're heading into earnings season, that's what you have to keep in mind. We could see negative growth year on year, but at the end of the day, what about the bottom line? Is that going higher year on year or not? If the answer is yes, it doesn't matter. The stock in most cases will outperform. In scenario number 4, this is, of course, bad management, and it happens a lot under inflation. Case in point, Tyson, where we see the growth year on year in revenues going negative because consumer demand, for example, goes down. But then you have the growth year on year in costs going higher in positive territory. We see huge reduction in the margins, and net income goes negative. Why? Because they have bad cost management. And sometimes it's not under the control of the company. For example, in the case of Tyson, the commodity price did not go down. Poultry, meat, that remained high. So the company had to pay in the open market and buy the product, but they couldn't sell it in the market for a higher price to the consumer because the consumer said, okay, if prices of meat go higher, I'm going to switch and eat something else or reduce my portions. All in all, that produces massive gap in net income and negative growth year on year in the bottom line, which produces massive moves to the downside in whatever that stock is. In the example we're using right now, Tyson, just grab a chart of that name and let's see what happened. The fifth and last scenario, and this is one that you have to keep in mind here because we will see a lot of that in the year 2024. What happens when inflation recedes, but we also see weakening consumer demand, aka we begin to head into a recession? In this scenario, if management is not really careful, we could see a reduction of revenue year on year exceeding the reduction rate in costs year on year. All in all, the net product is negative net income growth year on year. The margins get cut. We see the stock for whatever company it is that is showing this scenario here underperforming. And this is really important specifically for the big caps because you'll see a lot of them having a hard time cutting costs more than that what they've done already in the year 22 and 23. But what if consumer demand is so weak that the growth in their revenue continues to go down, but they have no ability to match that reduction in revenue growth year on year by reducing their costs too? Then in that case, case these stocks underperform. If this is the scenario that the big caps are about to face, then they're going to drag the stock market down with them. So again, folks, it's all about the margins here. This is really important for you to understand. Any stock that you want to add in your portfolio, you have to understand that it should have positive growth in margins year on year. And that could happen in many scenarios. We discussed 5 of them right now, the most common ones. If you see any stock in your portfolio producing negative margins and negative growth in net income year on year, that's a warning sign that you should be getting out of that stock. If it is a case of bad management, that could be corrected, of course, in the next quarter. But if it is a case, for example, as in Tyson, where it's out of the hand of management, you're probably better off cutting that position. So how do we know how the margins will look like in a certain year? Of course, we have to talk about the exception, and the exception is in bubbles, such as what we see in chips right now, specifically in NVIDIA. We have the AI mania. All of a sudden, we have a bubble in chips pricing. So we see a temporary surge in demand for that particular product. That's going to increase your revenues, and if your costs don't increase by much, then you're going to have really decent margins. Problem is, these conditions are transitory because sooner or later competition will catch up and the mania recedes. We see the demand going down for those chips. We're talking about NVIDIA, of course, because now we have alternative products, or economic conditions weaken that demand because AI mania is no longer attractive as it used to before. So that is the exception. And this is why we call them bubbles. They come and they go. But in a regular year and regular conditions, revenue really means demand. That's what it boils down to. What are the conditions of demand in the economy? What factors in the conditions of demand for any given year, but specifically the year 2024? Well, we have to look at consumer disposable income. We know that the stimulus program was really strong and we still have plenty of disposable income, excess savings that is, but that's also being reduced. We thought we're going to go negative in excess savings last year, but we got updated data, as we discussed before, that would probably happen by the second half of this year, 2024. Okay, so that's negative for demand. If consumer runs out of excess savings and disposable income, that's not going to be pretty good for the demand environment in 24. Consumer debt, because the higher the debt, the more restrictive of spending that is. And we see consumer debt going higher. We looked at plenty of data before in this program. That's a negative for demand in 24. Consumer behavior. Now that we have higher rates, we have inflation for years, savings are going down, debt has been incurred, consumer behavior shifts. They begin to spend more on necessities, not in travel and leisure, for example. So the shift in behavior is important for you to understand. Shift away from certain industries and spending means lower margins for those companies. While the companies that consumers stick to and continue to spend on, the necessities, for example, they could hold their margins better than companies that consumers are shifting behavior away from. Then we'll look at the fiscal policy stimulus. Are we anticipating stimulus or not? Well, we have a huge budget deficit, so we can't really do any stimulus. It's only going to happen if there is a disaster. So that's the negative for the demand environment for this year. The monetary policy. Now, the market thinks that if the Fed cuts rates, that somehow that's going to bring back demand into the economy and re-stimulate consumer demand in different sectors. The problem is the feedback that we get from rate hikes and rate cuts takes a long time to show up in the economy. We haven't realized the impact of rate hikes yet, not to mention rate cuts. That's going to take a long time because the consumer right now incurred the debt at a higher interest rate. It doesn't matter if you cut rates or not. That feedback will take a long time to relieve them from the debt that they've already incurred at a higher rate. So again, that's not pretty good for the demand environment in 24. And then of course we have the wild card of China stimulus. Chinese demand is really important for the margins of companies. If Chinese demand goes down, then you better hope that the domestic demand will make up for that. If that is not the case, then you better hope that you have really good cost management programs that you can reduce your cost and maintain positive margins. Well, we know that China is weak right now. The demand is weakening. But what if China initiates stimulus? And the end impact of that is the Chinese consumer goes back to spending. If that is the case, that could be one positive for the demand environment in the year 24. So just by what we talked about so far, you know that expanding margins from the revenue side will be really, really hard in 24 for the majority of companies. The trick now becomes expanding margins by cost management, aka inflation, because that's what really matters when it comes to cost. What impacts the cost environment, let's say in the year 24, but in any given year, but specifically 24, commodities prices. If commodities prices go higher, for example, energy costs, if oil prices spike higher, then there is nothing you can do about that as a company. You have to pay the fuel cost. If demand goes down, but your cost sticks higher because of higher fuel cost, there's nothing you can do here. You can fire employees and try to make up for that, but it's going to be really, really hard to expand margins in 24. And that connects with the geopolitical risk that we have, which we have plenty of. And that could be inflationary, aka higher cost for companies, aka lower margins, aka lower stock prices. You see how the connection goes? Fiscal policy is really important. Stimulus. If we have stimulus, then you can make up for your cost. It doesn't matter. Costs don't matter anymore. Of course, we're not anticipating stimulus right now. The monetary policy, rate cuts. The problem with that is rate cuts, at least from an anticipation or psychology perspective, could increase costs for companies because producers would say, okay, we might see demand moving higher because of expectations of rate cuts. Lending in the economy becomes easier, and maybe that's going to increase demand, so we have to raise prices ahead of that. That could be a negative for the cost environment in 24. China stimulus may be good in the revenue side, in the demand side, but what if that spikes commodities prices higher? That would be a negative for the cost side when it comes to margins. Supply shortages. For example, in the pandemic, when we've seen supply shortages, companies had to pay more for them. That's not good for margins. But at the same time, we had stimulus and inflation, and the consumer was spending, so you can raise your prices higher and make up for that increase in cost. What if you can't do that, for example, because the consumer is weakening, number one? What if you can't do that because you have no product yet? What am I talking about? And this is really important for you to understand. Big cap technology stocks, they're now engaged in an AI war. There is a supply shortage for the chips to fuel the AI war, meaning that these companies will spend more on these chips. That is an increase in cost. Can they make up for that by increasing their prices or expanding their revenues to make up for the increase in cost? Well, the answer is not yet. AI products, the development will take a lot of years before that becomes fruitful. And this is why I see that this is a problem for the big caps. And because of their waiting, that's going to be a problem for the stock market. The supply shortage, on the other hand, is really good for the chips because now their cost is down. Their cost is really the same. The raw material prices are down. Maybe they have to pay more for the manufacturers, like Taiwan Semi, for example. Yet at the end of the day, because of that supply shortage of their chips, they can charge more for it. And the balance between the increase in cost and then the increase in revenue expands margins higher. And this is why we see chips as the bullet stocks right now. Similarly, last year, the bullet stocks in construction were the companies that are selling roofing, piping, the tools, the nuts and bolts. These are the companies that were bullet stocks. Their costs not going higher by a lot. They already have the material right here, but they have an increase in demand, which means because of construction spending and all of the fiscal spending that we see, shortages of homes, etc. They have pricing power, so the revenue expand, their costs not much, and they did pretty good in the year 23. So that's the demand versus cost environment for companies in the year 24. What else is important here? The Fed policy in the year 24. See, we have two decisions. One of them is transitory, which is hold. We know cuts are coming. The question now becomes when and how. Because whatever the Fed does will impact our portfolios. And if you don't understand this, you're going to make wrong decisions in buying and selling stocks. The decision to hold, let's say that it is for the good reasons, meaning the light at the end of the tunnel period or the soft landing / Goldilocks period. We see inflation going down, but the economy is still holding. And we're now just anticipating rate cuts. We see the dollar going down. We see bond yields going down as we've seen in the month of November and December. And that, of course, benefits dollar and yield-sensitive stocks, which is the majority of stocks in the market. On the other hand, if the decision is to hold, so there's good hold and there's bad hold. Good hold is probably what we're seeing right now, just a little bit, but mostly what we've seen in November, December of last year. The bad hold could come really, really soon. And that is if inflation continues to go higher, sticks, but most importantly, moves higher, then what's going to happen? Fed is not going to cut rates anytime soon. Fed will decide to hold, and that's going to move the value of the dollar and yields higher. That will be net negative for dollar dollar and yield-sensitive stocks in the market. But folks, we know that it's just a matter of time before the Fed begins cutting rates. So we have to talk about the cuts. We have two kinds of cuts here, good one and bad one. The good one will be a preemptive cut, meaning the Fed says, okay, we've done enough progress on inflation, but we see risk of a recession, so let's do a preemptive cut, get ahead of time here, and reduce our recession risk. At the risk, of course, of propping inflation back up, but we're confident that that's not going to happen. Usually, in this case, we see the dollar and bond yields going down. We see equities going higher. But then we have the reactive cut, aka the bad cut. Usually that happens when the recession risk in the economy becomes more and more clear, and the Fed decides to cut rates to mitigate the risk of a recession. Initially, we see the dollar and yields going down. We see equities maybe reacting positive in the beginning, but then going down along with the dollar and yields. Then the Fed begins to cut more. We begin to get more and more bad news about the economy. Now the Fed is in a rescue mission. Unemployment rate is moving higher. The Fed begins to cut more. At some point, and I'll show you that in a minute, we see the dollar actually gaining steam because it becomes the last resort of safety. And that's when the market crashes and the cycle ends. Now, we have to talk about what is dollar sensitive and yield sensitive, because looking at the different scenarios for the Fed decisions, you'll make different decisions in your portfolio based on the movement of the dollar and bond yields. In this example, if the dollar goes higher, that is positive for what? Companies with growing margins, because the dollar can go higher, and that's net negative for the majority of stocks in the market. But if you have companies that can defy that and produce positive margin growth year on year, it doesn't matter what the dollar does. Those stocks will do pretty good. So dollar can go higher, but the chip companies, because of the AI mania, still have the pricing power and decent expansion in margins. Doesn't matter what the dollar does, their stocks will move higher. Also, when the dollar goes higher, exporters to the U.S., say, for example, the German automobile manufacturers, dumping cars here, they sell them for a higher dollar relative to the euro. That's going to expand their revenue just from the currency impact alone. And of course, U.S. importers, if the dollar goes higher, if you have a company that imports products from China, Vietnam, and then sells them domestically, well, their purchasing power goes higher. They can buy more for less. And the classic example for that is Walmart. Walmart, of course, buys stuff from China, sells it here. If the dollar goes higher, they can buy more for less and expand their margins. Again, it's all about the margins here, folks. You look at the chart of Walmart here in orange and then the dollar in green. You can see that there is a correlation here. Walmart is not sensitive to the dollar going higher. It actually thrives when the dollar goes higher. And then we see U.S. shipping companies, not all the time, so it's not the strongest case, thriving under a higher dollar. There are reasons for that. And most of them revolve around higher dollar equals lower commodity prices, most importantly, fuel prices. So we see the cost going down for these companies. But because of the strength of the dollar, we see U.S. importers buying more stuff from overseas, meaning more business for these shipping companies. All in all, the revenues expand, their cost goes down because of the stronger dollar, and their margins expand. But we don't see that happening all the time. It depends on the stronger domestic consumer environment. Now, when the dollar goes higher, that's of course bad for U.S. multinational businesses because they sell stuff overseas in foreign currencies. When you convert those sales to U.S. dollar, the currency impact will lower your margins. And most of these multinational businesses are staples, industrials, so they're impacted by a higher dollar negatively because also demands. Think about Caterpillar, for example. If you're China or any other country, you want to buy equipment from Caterpillar and the value of the dollar is higher. Your conversion rate is now more, so you have to pay more for this equipment. So we see stocks like Deere, Caterpillar performing negatively when the dollar goes higher. Commodities, that goes without saying. The dollar goes higher, the prices of commodities go down. So we see commodities-related companies and stocks not doing pretty good. Among them, of course, fertilizers, oil stocks, metals. And as we've said, Chinese and emerging markets don't do pretty good when the dollar goes higher. And the reason is what we just talked about in the discussion of industrials like Caterpillar or Boeing planes. Chinese companies will have to pay more for U.S. products. And that's net negative for Chinese companies. And this is why when the dollar goes higher, we see Chinese equities underperforming. Now, when it comes to bond yields, when they go higher, what is that positive for? The answer is value stocks. Value stocks usually have really good balance sheets, good cash flow. They have a lot of their cash parked in yield-generating instruments. So we see a lot of value stocks outperforming. Insurance companies, when interest rates go higher, they can charge more because the value of the stuff they insured also goes higher. The value of loans go higher. So if you're going to finance a building or a car, now you're paying more. The value of that product goes higher. So insurance will use that as an excuse to jack up their rates. And of course, what do they do with the cash, these insurance companies? They park them again in yielding instruments. With higher rates, they make more money. Credit cards. So long as the consumer demand is healthy, consumer swipes the credit cards. They pay these credit card companies higher rates. So we see stocks like Visa, MasterCard been outperforming for a while. But if consumer demand weakens in the economy, then higher interest rates doesn't help them because the volume is reduced. So they can charge more per transaction, but then the volume goes down. Higher rates also positive for the pricing power. So any company that enjoys pricing power thrives under higher yields. Think about the year 22, for example. A lot of oil companies, a lot of oil refiners, rates were going higher, prices of commodities were going higher, but they can charge more. They have the pricing power. They can charge the consumer more. Low unemployment rate in the economy, and it is a necessity, so they have the pricing power, and they tend to thrive under these circumstances. Now, higher yields and higher interest rates are negative for financials. It wasn't that way for a long time, but quantitative easing, of course, distorted everything here. So financials used to make more money, banks used to make more money when rates go higher because they can charge more on these loans. But now, because of their investment in bonds held till maturity, the value of these bonds go down when yields go higher. So all of a sudden, financials face this problem. Also, since depositors anticipate higher rates and a lot of financials did not really recover, all of the banks did not really recover from the GFC fully, at least. Even till today, they cannot really afford to pay depositors higher rates. So they see exodus in deposits, and that's a net negative for them. Wasn't that way before quantitative easing. Higher yields were actually good for financials. Not anymore. Higher rates also not good for dividends, because now you have the risk-free rate going higher. What do you need dividends for while you assume the risk? If you have the risk-free at 5%, but the dividend rate is 3.5%, why even bother? Profitless companies, all of a sudden not appreciated when rates go higher, because when rates go higher, investors want to look for the expansion in margins. And if you don't have profits, you have no margins. So we see these companies going down. Same goes with high debt. Now you're going to pay more to service that debt. Then the company's interest rate expense will go higher. That's going to reduce the margins. So that's not good when rates go higher. Small caps, because they have profitless and high debt companies, we see small caps underperforming when rates go higher. Real estate, when rates go higher, they pay more to refinance their debt. And at the same time, we see consumer demand weakening, at least in the housing market, because of higher mortgage rates. Utilities, dividend-paying stocks. Why bother when the risk-free rate pays you more? Home builders, it's the same thing. Higher mortgage rates slow down the demand for home builders. We haven't seen that yet because of the shortage in supply to begin with. We have seen home builders outperforming as interest rates continue to go higher. But at some point, those higher rates will catch up with home builders. There's a lag impact before we're seeing it showing up in home builders. And this is really important for you to understand when we say, okay, what are we short in 24? Could it be the home builders? I think so. Maybe not right now. You need to wait for it a little more to see the impact showing up in their earnings results. And then they'll make a good short in the year 24. So this is really important for you to understand. Now, the question could be, since November, we've seen the dollar and bond yields going down. We've seen financials, the rate-sensitive sectors like financials, dividend-paying companies, real estate, small caps, rebounding big. But we haven't seen dollar-sensitive sectors such as fertilizers and commodities and Chinese stocks recovering as much as the rate-sensitive sectors. The answer to that is, if you look at the performances of the dollar and the 10-year bond yield, let's say since the tops in October of last year, the dollar is only down about, let's say, 3% or so. Bond yields on the 10 are down almost 18%. And this is why we see the impact of the reduction in interest rates showing up more in the economy. And let's say, to be honest, the stock market. But we're not seeing the impact of the reduction in the value of the dollar showing up as much. So again, we go back to the Fed map here, what they're going to do about holding or cutting the policy, and how that's going to impact the dollar and yields, and the decisions you'll make based on that. But understand that in the last scenario, cutting because of a reactive reason. You can see the dollar and yields going down for the wrong reasons and equities underperforming regardless of their sensitivity to lower bond yields and the dollar. Why? Why? Because the economy is going down. Example, go back to 2007, 2009, the GFC. When the Fed pauses, you can see the SPX, the weekly chart, the S&P 500, and in orange, the federal funds rate. When the Fed pauses, that's really good for equities. The pause is good because we can speculate, oh, the Fed is going to cut rates next and demand will recover in the economy. We can fluff up the valuations all we want, but then the Federal Reserve cuts, and they usually cut for the wrong reasons. And this is why in the majority of cases, rate cuts are actually not good for the stock market. So we see the stock market going down. And then, of course, in the GFC, the Fed resumed cutting rates after pausing cutting them, resumed cutting rates in the month of October after the collapse of Lehman Brothers. And as they resumed cutting rates, even though yields went down, we see the stock market crashing. Why? Plug in the dollar. Here it is in white. You can see the dollar and interest rates go down together when the Fed begins cutting rates along with equities. But there is a point when the systemic risk hits and folks migrate from equities to the dollar, the last safety and the last resort of the US dollar. That's the moment when we see crashes, cuts don't matter, the dollar goes higher, everything goes down. Then, after the crash, when the dollar tops and begins to go down, we enter the recession phase. And in that recession phase, as the dollar retreats, you begin to see that commodities, metals, oil lead the recovery. We'll talk about that in a minute here. Now, if you made it throughout all of this, congratulations. Now we begin talking about my portfolio after all of this understanding. Here's what my portfolio looked like the last time we've done a video about it. I had exposure, lots of exposure in energy. So that's the leftovers of 22. Began to add in healthcare, and we maintained some exposure in staples and metals. My picks in the construction mania and industrials were still there from the years of 21 to 22. And here are some updates that I've done in the year 23. And most of these updates were announced in Discord. I know what your criticism is going to be. Maverick, you have to document and organize your moves a little better. So this year, any move, addition, cut, will be announced in the Maverick portfolio tab in Discord. Every move. Otherwise, you can hold that against me. But since we talked about my portfolio last year, here are the moves that I've done. I sold Chevron, and I announced that on Twitter. And that is because Chevron acquiring Hess, which I thought it was a lousy deal, so I sold Hess too. Sold Marathon because it went way too high, and we talked about this in the program. I covered the chart, and I said, look, I'm selling my shares here, went too high too fast. I sold my construction mania stocks, Hubbell, Owens Corning, Grainger. I think they're really decent stocks, but they went way too high, and just as in life, you leave while you're still on top. What I see in construction right now, of course, the slowdown in the fiscal spending because of deficit. So government projects will slow down. Likewise, when you look at multi-family residential, the incoming supply is huge. So now we see reduction in the permits for these projects. In other words, probably the margin expansion for these companies, the pricing power for companies like Hubbell, Owens Corning, Grainger, that's probably coming to an end here. So I'm leaving at what I think closer to the top as you can get. And we'll look at the charts in a minute here. Then I sold FMC at a loss, was my worst performer of 23. Taxation reasons, sure. Maybe it's worthy of adding again at this point. We'll look at the chart in a minute. And of course, we have to cover the fundamentals. A name like FMC thrives if the dollar goes down. We see grains pricing going higher and recovering again. Then we see the demand for these agricultural products going higher. In staples, I sold PepsiCo this year after the news that we got that they're getting kicked out of European supermarkets because their prices are going higher. To me, that's an indicator that they're losing their pricing power. And honestly, the chart doesn't look good anymore. We'll look at that in a minute. Hershey's. In the last coverage, I gave you my number where I'm going to cut my Hershey's exposure and why. Cocoa prices. If they go higher, we got a problem. So you can refer back to the video, but we'll look at the chart in a minute. So Hershey's is out right now. Maybe it is worthy of adding again. We have to look at the chart. And then I added to my exposure in Conagra, Constellation Brands, and General Mills. I think that these companies will have better margins as their cost goes down because of the reduction in inflation. But as the consumer gets weaker, spending will be concentrated in necessities. And of course, when interest rates go down, these dividend-paying stocks tend to outperform. Not to mention, of course, that at least in the cases of Conagra and General Mills, they went down big. because of the assumption that Ozempic will reduce consumer demand. I think that's misguided, and it was also one of the reasons why I added at a lower price here to my exposure in these two names at least. We'll look at the charts in a minute and the fundamentals in a later video. But again, here's what my exposure used to look like. So let's look at the charts and see why I decided to do some of these decisions here. So if we begin with Chevron CVX weekly chart, you got lower highs and you got 140.46 is a really critical support here. With oil prices going down, I see that perhaps Chevron, after losing their cash advantage by acquiring Hess at a really high price, I don't think that's going to help here. And breaking that support will produce more losses to come in the stock. And this is why I think I got out at the top, at least as much as I can, closer as I can. If we see the Fed cutting rates for a preemptive reason, oil prices recovering again, then I'm going to consider Chevron to be added. But right now, we're done with it. And it could be a break to the downside here, losing support in an inverse ABC. So you got to be careful if you have Chevron. Now SLB, if you look at the weekly chart, I still have it in my portfolio because this one is still maintaining an upward trend. Not to mention, of course, that the fundamentals for the company are still holding. So long as we have a positive trend, I don't see a reason to cut my exposure here. Next, we have Valero, VLO, weekly chart, still having an upward trend here. And as we see a recovery in the gasoline RBOB futures, there's a possibility that we can see these refiners outperforming. And as we hit a recession, the exposure to pure oil plays such as Exxon, Chevron, at least if you believe that we're heading into a recession in a slowdown environment, is probably not a good idea. But exposure to refiners, they tend to be more resilient even under a recession. That doesn't mean that they're going to outperform and just keep going higher. They're actually going to go down. But between now and then, they could outperform their peers in the pure oil plays. MPC Marathon weekly chart still way too strong, upward trend never broken, but as we will do in the fundamental analysis, I think that the value and the opportunity right now, at least in my opinion, is in Valero, not MPC. I think that went way too high too fast. I took the opportunity of reducing redundancy in my portfolio by booking profits in MPC and sticking with the laggard VLO. When it comes to Oxy weekly chart, what do we see here? It looks similar to Chevron. You have a rising trend and you have a falling trend of lower highs with a critical support at around 55.5. Breaking that, it's probably going to happen hand in hand with Chevron. But in the case of Occidental, at least they have the Buffett put. I know the lower the stock goes, Warren Buffett of Berkshire Hathaway will buy more, and that's going to keep a floor. Now, there are a lot of possibilities, as we discussed in the scenarios for the Fed, where we could see oil prices coming back up if the Fed cuts prematurely. We could see short covering in oil. So I need some exposure to oil. And I think that Oxy gives me enough exposure, limited exposure, so I need just one name, and I'm going to stick with Oxy because of the Buffett put. HES, Hess Corporation, weekly chart. Again, it's a good-looking chart, but it broke the upward trend, and now with the acquisition of Chevron, the gains are limited. We put a ceiling on it, so there is no need to have it in my portfolio anymore. We look at EQT, natural gas. We know that we have a really strong range here, 31 support, 45 resistance. Breaking above 45 indicate that probably this break is going to be for real and higher we go. Breaking below 31 will seal the deal here and down we go. So for now, EQT looks okay to me. Natural gas prices fluctuate, but the demand for natural gas, LNG, that's still going to be a theme here, specifically European demand. So I need exposure to EQT. We're now exporting more LNG than ever before in this country. So I need exposure, at least I think I do, and I'm going to keep it at EQT. But I might have some redundancy with Coterra, CTRA. If you look at the performance, the weekly performance since the year 22 began, EQT up about 55%. Coterra, on the other hand, up only 13%. So I think it's clear which name I'm going to keep in my portfolio here. But understand that EQT is a higher beta, meaning that if these names go down, it will go more than Coterra. So this is another battle that we have to do a video on. EQT versus Coterra. We've done it before. I think I went with EQT as the best choice, but do we have any updates in that battle? Now we move to my healthcare exposure. I have Amgen weekly chart. Again, upward trend. We have higher lows, higher highs, so what's not to like here? Maybe a little too excessive right now. It pulls back, but it doesn't matter. The stock is maintaining upward trend, and we have healthcare being a really good theme as the economy slows down and we head into a recession. Now, of course, is Amgen the best choice? We'll find out. When we do the fundamental analysis, we'll find out. Maybe Merck is a better choice. We have to do the comparison. Then I have AbbVie. We're doing the technicals for now. That's it. Weekly chart. we have two trends here. One of rising trend line, higher lows, and another one of declining trend line, lower highs. That was resolved by a break to the downside, so that was a negative. But then AbbVie managed to come back. As we've seen interest rates going down, a high dividend paying stock such as AbbVie managed to recover, so long as it trades above 155 and maintains this look right here. And if it grinds higher, that's a cherry on top. But I like the exposure here. The stock is holding a good trend. Now, I wouldn't say it is the most positive trend because we're consolidating right now for about, let's say, 2 years or so. But so long as we're consolidating and I can capture the dividend, I consider that to be good. Now, what we have to look for is, are we forming a new trend now of higher lows? If that is the case, again, more reasons to keep AbbVie in the portfolio. What about Abbott? Weekly chart. It's been stuck in a range here, pays a good dividend. I don't mind if the stock is stuck in a range. I don't want it to go down. That's the beauty of a dividend stock. Capture the dividend, maybe a little bit more upside in the stock. So for now, we'll keep it. I don't see a reason why I should take Abbott Laboratories out of the portfolio. Now, do we have other names in medical devices that are probably better than Abbott? Perhaps. For that, you have to wait for the fundamental analysis. For the technical analysis alone, stock been moving higher, still within range, maybe a little overbought right now, it pulls back, and then breaks above this range. Then you have more reasoning, technical reasoning at least, to keep the exposure here. Then we have J&J, Johnson & Johnson. We have a rising trend facing a declining trend. That's going to be resolved one way or the other. This is, of course, a monthly chart. It's going to take a long time to play out. But the bottom line is this is a conservative name, good balance sheet, and the technicals right here. So long as we maintain the upward trend, I see no reason to get rid of it at all. Regeneron, upward trend, getting a little too excessive right now, but so long as it's maintaining the upward trend, and I do like the fundamentals too, why not keep it? Then we have Cigna, weekly chart. We had a trend of higher lows and higher highs. It appears that we kind of stalled here. And if we indeed form a lower high in this chart, as you can see, which appears to be the case for now, but there is a possibility that the chart could muster the energy and crack above this sloping line of resistance. If it does, I'll keep it. If not, if we continue to go down from this point on, it is a rejection. And that would be, by the way, if we lose, let's say, 280, 285. If we lose that line, then it's going to be clear that we have maintained a higher high and higher low pattern, but now we're moving to a lower high, a possibility for a lower low. So I'm going to get rid of Cigna because of technical reasons alone. Now we'll look at Verizon, weekly chart. What do we see here? We bounced off support, and now you got a reversal from a declining trend of lower highs and lower lows to a new trend of possible higher lows and higher highs. Pays a good dividend with interest rates going down. The margins will become even better. I see no reason to get rid of my exposure in Verizon here, at least from a technical standpoint alone. I see a reversal from being bearish to bullish, so we'll keep and even add to Verizon at some point. Then I have exposure in the EIDO, the Indonesian ETF. Monthly chart, again, declining trend, lower highs, lower lows, but are we about to break above? Now understand that this is pretty much a bet on nickel and metals. It has a lot of Indonesian banks, but that's what the economy is all about. It's about metals and the EV race. Now, this is a monthly chart, meaning that this is a long-term investment, and the trend of EVs may be struggling right now, but the demand for resources is going to recover, specifically under a recession. When recession comes to picture, prices go down, these companies will use an advantage to accumulate resources in lithium, in nickel, in copper. Of course, Indonesia, big producer of copper, big producer of nickel. So I want to stick with this exposure right here, but I'm outlining the line of 20. If we lose 20, then we got a problem here. We have to cut the exposure. We move to industrials now, and I got LMT, Lockheed Martin, weekly chart. Do we see anything here, any reason to get rid of this exposure? No. Initially, it began to go down and look really weak because the anticipation was, okay, the Ukraine war is over. The demand for defense contractors will go down. Then came October 7th and the war in the Middle East. Now we have more reasoning to keep exposure to the defense contractors. LMT is my choice, and I think the fundamentals are good. The demand will stay strong. We are in a really dangerous geopolitical world, so you combine that with really good technicals here, maintaining a breakout in a bull flag pattern. I think that you got to stick with this exposure here in LMT. Then I have FAST, Fastenal. So you have one trend that was positive, that was broken, forming a negative trend, trend number 2. We got the inverse on his shoulder. It took a little bit of time since we bought the stock in 23 for it to break out. Now we have the breakout. It is working out. It is reaching the previous trend. That could be resistance. We pull back, then we recapture that trend and back in positive trend again. So this is why I'm keeping Fastenal versus, let's say, the names that already went higher, like Hubble. Been holding this stock for a long time. Still looks good, inverse on his shoulder. We're at the highs again. But for me, looking at the data, I think that the majority of construction spending is now coming to an end. And since the stock already rallied higher into that, why not leave while you're still at the top? Same goes with OC, Owens Corning. Really good chart at the highs. I'm not saying it's going to go down here, but for me, I made enough profits. The chart's still positive. If you want to keep it, that's your choice. But mine, I made enough. I want to move that cash to a money market fund and receive 5% interest rates or so, risk-free, rather than chase the last 5% of the stock, and then what if it goes the other way? Then we have Grainger, GWW. Again, positive trend at the highs. If you still like the chart, keep it. It's a good chart, but for me, I think I made enough, and I want to use the cash for other things, so I got rid of Grainger. With that being said, the chart still looks pretty good here. FCX, Freeport-McMoRan, monthly chart, declining trend, lower highs, but consolidation. And if we see the dollar going down, we could see a breakout in copper. I'm showing you a monthly chart because copper is going to be a long-term theme. If we have China stimulus, as we talked about before, if we have preemptive rate cuts, even after a recession, I think that a name like Freeport will maintain this advantage as one of the largest producers of copper in the world. Now, if we begin to go, let's say, below 30, then I'm going to become nervous about the chart. And if we have a severe recession and we see a spike in the dollar before it happens, you'll know what's going to happen. If we have systemic risk, if Charles Schwab is blowing up, or bank so-and-so is in trouble, then you know sooner or later the dollar is going to spike higher and a name like FCX will crash big. So before that, we'll get rid of the name because of technical reasons, but again, it's a long-term theme, so even if I get rid of it, I'm going to buy it again. FMC weekly chart, here it is. Got rid of the name, but we filled the gap at 62.27 on the weekly chart. If we maintain this low here, then we have a higher low and a possibility for a recovery. Confirmation above 75, so I'm not in a rush here to add the name. I want to see at least that the name is trading above 62.27 before adding it back. Corteva, maybe better exposure here. Weekly chart. Been losing in the year 23, hasn't been a good hold, but we're back pretty much where I began accumulating the position here. The chart is holding on to support. It retested support, let's say at around 44, over and over again, and it's been holding so far. Why am I keeping Corteva? Why do I see perhaps an opportunity in 24 in these names? From a technical standpoint alone, since we're just talking about technicals right now. Plug in the 10-year yield. What do we see here? We see a correlation in the weekly chart of Corteva and the 10-year yield. But recently, since the summer, we've seen a divergence. 10-year went higher, then went down, but Corteva just kept going down. If we see a recovery in bond yields because interest rate cuts are not happening as soon as we anticipate, then wouldn't it make sense that we have a recovery mission here in Corteva? I think so. Then I got WPM, wheat and precious metals. As you can see in the monthly chart, this is going to be a long-term theme for gold. I see an inverse in his shoulder, confirmation breaking above 52. For now, I'm going to keep it because I see the chart is positive. And of course, the demand for gold, I think as we see a slowdown into a recession, I think that gold will begin to outperform. If we look at my staples, Kroger, monthly chart, been holding this forever, capturing a really good dividend. 43 is a line in the sand here. If we go below in a monthly chart perspective, it's probably because the economy is heading into a recession and we have peak gains here in Kroger. So that would be the point where I'm going to cut my exposure to this name. Otherwise, so long as it trades above 43, keeping it in the portfolio. Then we have Cody, monthly chart, inverse on his shoulder, got it really cheap. Now, if we break above 13 in the monthly chart, then we're probably going to have more gains to come, so we're keeping Cody for now. Conagra, CAG, added to the name because it was an abysmal year for 23, big drop, but again, this kind of chart, it goes down big as I'm highlighting here, then it recovers, so it has the tendency of overreacting to bad news. But it is a solid performer, it's a good company. We'll cover the fundamentals, of course, in the next video. But for now, from a technical standpoint alone, I see a break above 30.5 from a weekly standpoint and closing above is a confirmation to keep that exposure. Breaking below 26.61 from a weekly standpoint will be a warning sign that we probably have an inverse ABC in hand. We have lower lows to come. If we look at PepsiCo weekly chart, We talked about the fundamental reason, which is probably losing the pricing power. The technical reason is we broke an upward trend here in the weekly chart, forming a possibility of a bear flag pattern with the confirmation line at around 159.5. You break below that, got a bear flag. This is going to be the end of the gains in PepsiCo, so this is why I decided to get rid of the name. Hershey's, here it is. And last time we talked about the 250 line. They have my puts at 250. Exercised those puts and I sold Hershey's at 250. That was a really good choice. And the reason is it kept flushing down. Is it too oversold now? You can make that argument. But before we do that and re-add the name to the portfolio, plug in cocoa prices. You can see it in orange here. Now, Hershey's is accustomed to the fluctuation, the regular fluctuations in cocoa prices. They hedge against that, so that's okay. But the problem is, look at where trouble began, as I'm highlighting here. Why? Cocoa began to break above the previous highs. That is a territory where Hershey's is not accustomed to, that we see a break above the highs in cocoa. They're not hedged against that. So that's the moment when we've seen Hershey's stock suffer. You gotta see a peak and a reversal in cocoa before we see Hershey's recovering and being worthy of being picked up again. It's a really good company, fundamentally speaking, but from a technical stand alone, not good, at least not right now. Then we have Constellation Brands, STZ, weekly chart, steady eddy, within range, dividend paying stock. That's what we like to see. Of course, breaking below, let's say 230.61 will be a warning sign for me from a technical standpoint alone, that we could go down and fill the gap that was never filled from after the pandemic. That's only going to happen if the economy is heading into a recession. We see demand from breweries and bars going down. We're not there yet, but you have to be aware of it. And this is why this line is really important. 230.61, we lose that, we got a problem in the economy. Then we have GIS, General Mills, weekly chart. What do we see here? Ozempic mania and the loss of the pricing power, the reduction in inflation in the prices of cereal, all bad combination for General Mills. So the stock underperformed in 23. My line in the sand is 65. We have to go above to keep this name. We had a triangular consolidation pattern. Now it's being broken to the downside, with the line in the sand being 62.35. So far, technically speaking, it doesn't look good. On the monthly chart, if we look at the Bollinger Bands, we see that they're expanding to the downside, possibility of a bear flag pattern. GIS is running out of time here. It needs to get out of this consolidation range, close above 65 from a weekly standpoint, and trend above. Otherwise, if this dynamic continues, we could see more downside as the margins once again go down for this company. They have to recover margins by, unfortunately, getting rid of employees. If they do that, the stock is going to recover. If not, we have more downside to come. So now I probably have a redundancy issue with the exposure of Conagra and General Mills. So we have to do a comparison between the two from a fundamental standpoint, because technically they're kind of similar. The fundamentals will seal the deal here, which name I should keep and which name I should get rid of. And lastly, Mondelez. Now this one went down just like General Mills and Conagra because of the Ozempic mania, but it maintained an upward trend and it managed to recover. The problem with this stock, technically speaking, is on the weekly chart we see a trend of lower highs. Now breaking above, that's going to be positive, and we keep the name. Maintaining the lower high would be a warning sign for me from a technical standpoint alone. Now I'm going to have to look at the fundamentals. If they're also aligning with this lower high, then I'll make a case that, okay, we're done with Mondelez here. But from a technical standpoint alone, too early to say that. We could have a break in this negative trend, supported by the fundamentals. If that is the case, we're going to keep Mondelez here. Okay, so this is what the portfolio looked like, and I showed you all of the charts and my reasoning from a technical standpoint alone. Here are the names, updated portfolio, the names that we got rid of. What did we add in the year 23? And again, I'm going to organize all of the additions in the Maverick portfolio in Discord, I promise you. But all of these names were mentioned in Discord too, in the chats, in the live streams, in the videos. Last year, I added Cameco, Medtronic, McDonald's, AMD, SLK, and Luminar. Cameco was the earlier addition. I added at the price of 35. Medtronic came after that. We've seen the drop of the Ozempic massacre. Along with McDonald's, I had a trade on it at 250, and I exercised the calls, so I own McDonald's at 250, while AMD was added once they announced their new chips that will compete with NVIDIA. I think that if AMD captures just 10% of NVIDIA's business, the valuation and the margins will expand dramatically. I'll show you that when we do the fundamental analysis. So I added AMD, and then among the light at the end of the tunnel portfolio, I added SLX, which is the steel ETF, and Luminar. So let's look at the charts for these names and see what they look like. CCJ, a weekly chart for Cameco, way too high, overbought, got it. Maybe we're pulling back in an ABC pattern, but what is this chart tracking right now? Plug in uranium prices, the spot price. That's going higher. So that suggests that CCJ is going to recover. Just pulling back right now from a technical reason alone. So long as uranium continues to trade higher, CCJ will follow. And then we got MDT Medtronic weekly chart. Now, I added this name because of the big drop after the Ozempic reason that, Ozempic will cause less demand for heart surgery devices. Doesn't make sense at all for me. Ozempic is going to eliminate heart disease. It's a long shot. So I saw value in Medtronic. Of course, we need to wait for the report, the next one, to see what the margins look like. But for now, from a technical standpoint alone, a recovery from Fib support. We're above the Fibonacci retracement right now. About, let's say, 0.25%. Forming an inverse in his shoulder. From a technical reason alone, I see that I should keep the stock, and if the fundamentals agree, then we'll just keep adding to it. MCD McDonald's monthly chart, upward trend, some exceptions during the pandemic crash, but we've been keeping this trend higher. I got it at 250 because of the crash of Ozempic. Good price, we got to the 300, but I might have a decision to make here. If this high sticks, then maybe we have a possibility of a double top. And I want to get rid of the stock if that is the case. AMD monthly chart. We discussed the fundamental reason, but what about the technical reason here? We got what it appears to be a cup and handle pattern. Then came the breakout, so we got a technical justification here to own the stock, and we're now above the highs. Maybe overbought in the weekly and daily charts, and we see pullbacks, but the monthly chart says, so long as the story remains intact, the margins of AMD will continue to expand, and with that, the chart will follow. If we look at the SLX Steel ETF monthly chart, what do we see here? It's been consolidating in a range for about 3 years now, with the breakout line being 62.22. Well, we're above now, and we're forming a trend of higher lows. Not comfortably above, would like to see a bigger breakout here. But for now, from a technical standpoint alone, the breakout is good enough for me to keep the chart or keep the stock in my portfolio. And then we have LAZR Luminar. Did we add this because of a technical reason? Maybe because we got the falling wedge and we got the break. But now what? We're back at the lows again. Is there a technical reason to keep this name? The answer is no. This is not about the technicals at all. We can make an argument. If you look at the RSI and the weekly chart, maybe we're seeing a positive divergence here, or we see a recovery. But the addition of Luminar was a wild card. If we go back to the Fed decision tree, if we see the preemptive rate cut, or we see the hold for the good reason, stocks like Luminar could outperform. And for an exposure that only going to cost you $2 to $3, why not have a wild card in your portfolio? Just pick your pick, whatever it is, doesn't matter. Have one pick as a wild card. So here it is, folks. The old portfolio. We got rid of some names. We made room. And here's the updated portfolio. In energy, I got Cameco, SLB, Valero, Oxy, EQT, and Coterra. Healthcare, I got Medtronic, Amgen, AbbVie, Abbott, Johnson & Johnson, Regeneron, and Cigna. In communications, I got Verizon. International, I got the EIDO, Indonesia. In industrials, I got Lockheed Martin and Fastenal. In consumer discretionary, I got McDonald's. In technology, I got AMD. In small caps / the wild card, I got Luminar. In metals, I got FCX, Freeport, SLX, Corteva, and Wheaton. In staples, I got Kroger, Coty, Conagra, Constellation Brands, General Mills, and Mondelez. All in all, the distribution of my portfolio, 14% for metals, 24% healthcare, 20% energy, 7% industrials, 3% small caps, 3% discretionary, 3% technology, and 3% communication. Then I got 20% in staples, 3% in international. Now I see a problem here that 20% exposure in energy as the economy slows down may be a little too risky. 14% in metals may be the same, so we need to trim a little bit here. Staples at 20% also a little too high. You don't want to have exposure of more than 20% in one sector alone. So I have some decisions to make here. But if we look at the cycles, where are we right now? Are we in a recession? No, we're not. At least not yet. Are we in expansion? No, we're not. But this is what the market behaved like last year, because the market has the tendency of flipping into expansion based on expectations of the Fed policy. But in reality, the economy is probably in a slowdown environment. That's usually positive for consumer staples, healthcare, and industrials a little bit, but negative for materials and negative for consumer discretionary and real estate. So with that, understanding right here. Is the exposure in materials worth it or not? We have to look at these names again fundamentally because they tend to outperform in a recovery, as we discussed before. But the majority of my exposure is in healthcare, and healthcare does pretty good in a slowdown, and it continues to do good, maybe not as good in a recession, but it continues to hold. And then staples have decent enough exposure. I think they do pretty good in a recession. We're not there yet, though. All in all, you look at the exposure for all sectors here. If we assume that we are in a slowdown, then consumer discretionary is not good, materials is not good, real estate is the worst, and the best sectors to be in are healthcare, staples, and industrials. Last year, the market behaved as we are in an expansion mode. So we've seen technology doing pretty good, comm services doing pretty good, utilities doing bad, healthcare not as bad as it suggests right here, staples did bad, financials, which is supposed to do good under expansion, did pretty bad. And that kind of solidifies the case that last year was not really expansionary. Last year was all about the AI mania and the restoration of margins by big caps. In reality, we are now in slowdown, so we need to position our portfolios to reflect a slowdown environment. Little by little, we're going to have to move to a recession formation, shorting technology, shorting real estate, shorting comm services, while doubling down in consumer staples and healthcare. But we're not there yet. But now you have a better understanding of what the environment looks like, what I'm looking at when I decide to add or get rid of a name in my portfolio. And we have a lot of decisions to make, folks. So you have to wait for part number 2, which is the fundamental analysis for these names that I have right now. And then, of course, what do we need to add? Do I have a list of names that I love to add? What are the fundamentals looking like? What are the technicals in those names look like? That's going to be another part. I think we've done enough here. I don't want to keep these videos too long, as I said before. The initial video was, again, over 2 hours long. So we're trimming it into different parts. This is part number 1. I hope you enjoyed it and you found it informative. And if you did, you know the deal. You encourage the other members to upgrade. Hey, look, I watched the portfolio review. I've seen a lot of things that I didn't know before. Got a lot of information. Help us out here. But with that, folks, this is all I got for you for this video. We'll meet again for part number 2. But until then, this is all I got for you. Thank you for listening. Thank you for watching. And you'll hear from me again. Take care.